Hey guys, welcome to day where we're spending all month talking about different asset classes. If you've been in real estate for any length of time, you know that it has been a tough market in 2024. Well, it's been tough for what's been working for many, many months. I mean, years, decade, literally. But you know what? That doesn't mean that there's not new, growing, budding opportunities in other areas. And I got to tell you what we're talking about today with Nathan Turner, the Canadian note guy. He's going to share a little bit more about debt investing and how it works. But while we wait for people to show up, I've got some stupid jokes for you, Nathan.
Perfect.
All right.
I'm in.
These are some of the worst dad jokes that you can absolutely steal. Why did the debt investor go to therapy?
I don't know why.
He had too many outstanding issues.
Excellent.
Why are debt investors always so calm?
Why?
They know at the end of the day, interest will always come back to them.
Nice.
Why do okay, this is still a really horrible one. Why do debt investors make the best gardeners?
Why?
Because they're great at planting seeds and watching their interest grow.
Excellent.
Like I said, some of the absolute worst of the dad jokes. So always like to have fun with those.
Not bad.
So, but Nathan Turner, Canadian note guy, it's great to see you, and we catch up every year in person at your mortgage debt investing conference.
Yeah.
Now, it's not really just for investors, it's for everybody that's in the business, that are doing deals, that are making things happen, just to learn. Could you share just a little bit more about the conference that you've put together? There's hundreds of people that are showing up in Nashville every single year.
Mm-hmm.
It's a blast. I show up, well, about half of the reason because of your great conference. The other half of the reason is just because Nashville's a lot of fun. But if you don't mind, if you could share a little bit about that conference and
Sure.
then yourself. But let's start with the conference because it's awesome.
Yeah, it is awesome. We've really enjoyed putting it on. So we took this over a couple of years ago. My wife and I've run it here twice. 2025 is actually the 10th anniversary, which is pretty exciting. So we were talking about we got to get a cake or something. I don't know. We'll do something special.
I'll bring the sparklers.
Yeah, exactly. But yeah, it's a conference just for anybody who has any interest in the note business. So whether you're brand new and you've just barely heard of this, all the way up to people that have multi-million-dollar funds. That's everybody comes together, and it's just an awesome place to come and network, learn about maybe strategies you didn't know about. And then ideally what we're hoping to have happen is by the end of the conference, you've walked away with a deal. You've talked to somebody and you guys have struck, some kind of agreement, and now you're going to walk away, going home with the deal, at least started, maybe not completed, but at least started, so that you can continue on your note journey in some shape or fashion.
All right. Well, my Canadian name brother,
yes,
with a little less hair, but a little more smarts. If you could give a little bit of an introduction about yourself, where you came from, how you got into notes.
Yeah. So Canadian note guy, because I live in Canada. So not maybe the most creative, but that's it.
Crowdfunding lawyers, it's people understand what it is. Canadian note guy, we understand what you do.
Yeah. I've been doing this since 2009 is when I got started. And I live in Canada, but everything I do is in the US. I've just been Canadian my whole life. And so we looked at moving once years ago, and actually it's really difficult to move to the US. So we're just staying put. And
let's not get into how easy it is to just jump the border, and you could have been hanging out here for the last decade and a half anyways.
That's right. But yeah, I got into notes in 2009, and back then it was all about non-performing notes where people are not making payments on their mortgage. When I first heard of that, I thought that sounded like the most risky strategy I've ever heard of, but quickly learned how it's not actually. It's very well protected, and it's a great strategy, and it's a lot of fun. And we're doing performing notes now where people are making payments, and shifted gears just a little bit about a year ago.
Well, I got to tell you, the non-performing notes, I find it to be one of the sexiest asset classes to get into.
Mm-hmm.
But things change. It's like money is fleeting, and there's an availability of non-performing it sometimes, performing it other times.
Right.
I know the interest rates have really shifted the market and what's, well, good to invest in. But just to lay the land for everybody, could you define a performing versus non-performing note? And then I'm going to have some more questions about non-performing.
Sure. So to be clear, what we're talking about is mortgages, deeds of trust, and then you can get that whole category of contracts for deed, sometimes called a land contract, sometimes kind of bond for deed, agreement for deed. We just put all those under the umbrella term contract for deed. Essentially, what we're talking about is a lien against the property. Typically, it's a mortgage or a deed of trust, depending on the state. So that's just bare bones basics. That's what we're talking about.
And I think it's important to note that a mortgage and a deed of trust, it actually means the exact same thing.
Yeah.
It's really just state dependent. So when you hear these, just think interchangeably.
Yeah. And again, typically we call it all mortgages or just notes because it's just easier that way instead of trying to differentiate between which state does which one. So essentially what it is I step into the role of the bank. So somebody owns that note, they want to sell it for all kinds of reasons, and then I buy it. And now I am the new owner of the note. I have the right to collect payments. And then, so getting back to your question, you've got non-performing notes. That's where whoever is living in the property, whoever is the payor on that mortgage, is not making payments. And that could be true. Technically speaking, it's 3 missed payments in a row constitutes a non-performing note. So going back in time, back when we were buying these different non-performers, it was not unusual for somebody to have not paid on their mortgage for 2 or 3 years. Like, that was fairly common. So that's why when I first heard of this, I thought, oh, that sounds crazy. Why would you do that? But number one, there's a great discount involved in that. And then there's a ton of different exit strategies. All
right. Well, let's start with the discounts. I know that that's a huge piece of it.
Yeah.
And in today's market, and I know there's just less available than in the past. I know you were getting them for, 15, 20, 30 cents on the dollar. The world has changed. If somebody wanted to get into non-performing notes, kind of what's the pricing range that really should be expecting nowadays? And I know it's complicated with second liens, first liens.
A little bit, yeah. But generally speaking, the non-performing, part of it is there's less available, and part of it is the pricing has just gone through the roof. So like you mentioned, when we first started, 15 to 30 cents on the dollar was pretty standard. These days, I mean, if you can get 65 cents, you're doing a really good thing. Anywhere between, 65, you're getting a steal, all the way up to like 85 cents on the dollar. If you're talking like the big boys, I've heard of like 95 cents on the dollar, which makes no sense. So the cost of capital must be next to zero. But anyway.
Okay, well, I had 1,001 questions about non-performing notes.
Yeah.
But I'm here to completely ignore those because it just doesn't make sense based on what you're explaining. I mean, great strategies to work out, works out for the borrower, works out for you, blah, blah, blah. But who cares? Because like a lot of these real estate deals, that makes no sense anymore. So, hey, everybody, we were talking non-performing, forget about it entirely. It doesn't work.
But like you say, it is timely because that was a really good strategy for, 10, 12 years. I was just on a call before this one. We were talking about just kind of a group of note investors, people that are creating notes, selling notes, buying notes, we're starting to see those default rates creep up again. You're right. Yeah. So it's kind of the good news, bad news, I guess. Good for those who are looking for non-performing deals. Overall, it's bad news for the economy. That means that there are problems. There are things that are making people not make payments on their mortgage. So there's some kind of a stress there. And personally, I think we're going to see it get worse before it gets better, like quite a bit worse. I don't think 2008 proportions, but it'll rhyme.
Put that in context. People have been saying that since 2015.
Sure.
So how far will it go before the massive crash that's going to destroy the entire financial system?
Yeah.
Maybe
entire financial system. That would be interesting. So it's a good time to go back. If you haven't seen it already, watch The Big Short. Fantastic movie. You might have to watch it 2 or 3 times to kind of get it, which is fine. It's slightly complicated, but the principles are true and right, where everything's sunshine and rainbows. And then they get on the ground in Florida and they see, oh, wow, there's a lot of things where, they're vacant properties and they could start to see some of these issues. And that's what I'm saying is we're starting to see those issues right now where people are not making payments. Default rates are creeping up. And like you say, yay, good for non-performing note buyers, good for attorneys that are going to go through and do these foreclosures. But
have I mentioned that we're opening up a foreclosure department? So no, just totally joking. I also don't do bankruptcies because I like working with people that have money rather than the people that don't.
Yeah. But we're seeing, so it's not necessarily that, forget about that strategy. For today's market right now, it would be tough. Not to say it's non-existent, but it would be tough. But we're seeing those cracks starting to show. And so I think that's going to be a much more useful strategy over the next, 2 to 3 years at least, maybe longer. And it's funny. Now I just caught myself saying that because my very first note conference I went to in 2009, people were saying, well, how long is this going to last? And the classic answer was like, 2 to 5 years. Well, 12 years later, we were still doing the same thing. So I don't know.
Let me give my little pitch for everybody that's watching about why, regardless of what we're talking about in the markets and non-payments, non-performing, why, at least personally, I think real estate now, tomorrow, and probably forever is the place to be.
Mm-hmm.
For a reason that not many people think about, and that is our capitalist system. Mm-hmm. That the government actually has served as a backstop of every financial calamity for the last 20 years. And there is so much money and so much value, not with you and I alone, but with Wall Street, with the billionaires, with the guys that really have it. So if there's seriously a problem in the United States, I 100% believe that the government will step in to backstop, lower interest rates, make life easier. So that's at least my pitch why I'm still a massive fan of real estate, even though interest rates are going up, things are a little bit shakier.
No, and there's opportunity on either side, whether the economy is doing well or not. There's opportunity, and again, we'll kind of preface that by saying, when we're talking about buying a non-performing note, and this is pretty much across the board, anybody who's buying performing notes, your first and best exit on that is to get the person living there to make payments again. And that can be through a modification. That can be through, we can be far more creative than a bank can be because we bought it at a discount. So we've got tons of latitude to say, look, $800 wasn't working. Could you do 6? And then we can figure out something to do with your arrears. Like we've got far, far, far more bandwidth to just figure out all kinds of workarounds. So I really feel like the non-performing world, especially, we are absolutely part of the solution. We're not capitalizing on a problem. We're part of the solution. We're trying to make things happen, make it better.
Well, let's forget about what's not working, not forget about entirely, but for right now, let's talk
Yeah.
about performing loans.
Yeah.
Interest rates are like sky high for the last, highest over the last 20 years. Forget about the cut last month.
Yeah.
What's it look like actually buying and investing and even managing and servicing a performing loan in today's market?
Yeah. So that performing loan, again, is where people are making payments. So there's a bit of a trade-off there, because on the one hand, a performing note is far more predictable, far more, dependable on you can relatively well, you can expect when that person is going to make payment, and you can predict into, over the next few years, next several years, what your income is going to be on that performing note. Versus that non-performer that you picked up, it can go all kinds of directions. And I had it where, somebody, I thought for sure somebody was living there, and they'd only defaulted for, 6 months, very much more likely to make payments in that kind of scenario. And then all of a sudden we find out, oh, never mind, it's vacant. And then we have to switch gears and do a foreclosure. And that can take however long it takes in that state. Which
is interesting. There's a wide variety. Like, I know you can foreclose quick in Texas. I know guys that went 10 years without paying in Nevada and still didn't get foreclosed.
Yeah. I did as an experiment, I bought 2 notes in New York State. One was both like North New York. So one was right by Niagara Falls, actually. It's one of the only properties I've ever visited, but we happened to be at Niagara Falls. I'm like, hey, that one property is just around the corner. So we went and checked it out. There's that one, and then another upstate New York one. But we're not even talking in the city. And they had already started foreclosure, which was the only reason I considered it in the first place. I'm like, well, they've already started, so it won't take that long. It took like 2.5 years each to finish the foreclosures on those. They'd already started, and that's where I picked up. So that's a very different story than Texas, where on paper you can do it in 2 months. Quickest I've ever done is 4.
And I know that Texas has been a major hub for debt buying and investing.
Definitely.
Why is that, and what other states really are attractive to be acquiring debt in?
Texas is attractive for several reasons. The first one I think that most people think of is it's got that short foreclosure time. And so again, like, that's kind of your just in case, that's your backup plan. If something goes wrong and if I have to foreclose, Texas is going to be much faster than New York or Nevada or many other states, most other states, in fact. So that's kind of one of the first things that's attractive. One of the other things that makes Texas a really a great state, and there's lots of reasons Texas is great, but another one for notes is
I'm here, but literally not pitching it because I'm here. It is truly a good state and market to be buying debt.
It's a great one. It's a great one. I'm up in Canada, and I'm a big Texas fan for notes. Texas is it's the highest seller finance state. So of all the seller finance deals that are done across the country, 1/4 of them are done in Texas.
Wow.
A full quarter. So it by far the highest percentage is done in Texas. And the seller finance ones are fantastic performing notes. They tend to be higher interest rates. So even if your posted interest rate at the bank is 6, 7, 8%, a seller finance deal will probably pick up at that 8 at the lowest, and it'll be somewhere between, in Texas I've seen as high as 11.5. Okay. And in that range. So for me as a performing note buyer, I'm looking for my target yield. The higher the posted interest rate, the less I'm going to have to discount to get where I want to be on my return. So if it's sitting, all these loans that were locked in 2020, 2021 at 2 and 3%, those are going to be very difficult for banks to offload as time goes on. And I think they know it. And I think they're trying to figure out ways to work around that. And maybe that's a different conversation, but.
Well,
But
this is a really important thing to consider because, people think interest rates are at 7-8% today. Why would I ever buy a 3%? And there's actually a good answer to that.
yeah, it's a great question. For me, it's all about the yield return. So that 3% for me is really difficult because the discount on that for me to get where I want to be is huge. So to buy that, that's a toughie. I'm curious what you've got. Why would you buy that 3%?
I mean, how big of a discount are we talking? Because you have to basically double, triple your return
Yeah.
for it even to make sense. Now, the cash flow and the payments are little. However,
Yes.
the principal on actual final payoff, if not the amortization, is really huge compared to what that discount is. So if you're seeing those deals in the market, kind of what's the expectation? Or you're like, I just don't even deal with that, so I don't even know.
I actually just got a tape yesterday. So tape a list of loans that are for sale, performing loans, and the posted interest rates were somewhere between, I think it was like 3 on the low end and maybe 6, 5.5, 6 on the high end. Again, for me to get where I'm trying to get, like you say, we're talking like 50 cents on the dollar or more,
Wow.
like 50, 60, 70 cents on the dollar for those little 3%ers. So those are really tough to get those deals going. And then you got to take a step back from the bank's perspective. They're only lending this stuff at 3%. And they know that if they can somehow re-lend that same cash today, I mean, that's more than double for their projected income on that. So they're looking for ways. So if they can sell that, and if it makes sense for them, they'll take that cash back so that they can then re-lend that back out at a higher interest rate. So there's lots that goes on behind the scenes.
And you know what? I want to dive in a little bit deeper into the banking system and why the banks play ball with this, and then talk about those tapes a little bit more.
Sure.
If a bank has $100 in deposits, they can lend out around $1,000, 10x their deposit in loans.
Yeah.
Phenomenal. So that 3% on a deposit is actually more like 30% once they're able to leverage that up. So they are getting hurt if they have to sell it. However, because they're able to loan so much beyond what they actually have, it's still well worth it. And I can't even imagine what they're making nowadays at this 6, 8, 9% that I'm seeing, even with construction loans.
Yeah. And those construction loans, you're right. Those are even higher. So those are very interesting for the banks to get their teeth into, because we're all out here to make money. And so of course they're going to try to lend it back. So another comment, and I don't want to ruffle too many feathers. However, there's a big push these days. It's kind of the popular thing, I guess, where you're buying property subject to. It can be done, but there are some very, tricky points there. For example, if I'm buying a property subject to, so that means I am agreeing with the homeowner to say, essentially, I'm going to assume your mortgage. So I will take over the mortgage. You can get out of the deal for whatever sum we agree on. I'm then going to resell that property to somebody else, and they'll start making payments to me. Those payments will then go towards that first, and everything should be cool.
and this is the sub 2 that is really being heavily promoted by some influencers that are out there. And don't need to dive into who they are. They are doing a great job promoting themselves.
Yes, exactly.
From the debt buyer lender side, is it normal or easy to approve those types of deals? Are there like still guarantors besides the initial borrower? Like, how does that work from the debt buyer side? I don't really care about the other side.
Yeah. So that from the debt buyer side, here's my situation. So I would love to buy the loan that you've created with your new buyer. However, you've got that outstanding first behind it. So just give a scenario. Let's say that your new buyer, the person that's now living in the house, defaults on payment. And you, as an operator, as the debt collector, you don't have, for all kinds of different reasons, but let's just say you don't have the money to then pay the underlying first. The underlying first then starts foreclosure on the original borrower, because they are the ones that are still attached to that original mortgage. So it can get incredibly messy, incredibly fast. And so as a debt buyer, I am all about those wrap loans if we can pay off that underlying first when I buy the debt.
And then it's no longer a subject to, now
right.
it's just a regular debt.
It puts me back in first position, so there's nobody outstanding out there. And it's just so much cleaner, so much easier. So there's a big push with those subject to guys. Just make sure you're doing this correctly and make sure that you're doing it. And I'm not going to get into how to do that correctly. That's not my game, but
somebody else's deal.
But make sure you're doing it in a way so that if you are looking to resell that wrap loan, that whatever I'm going to pay you is going to pay off that first, and you're not going to have to come out of pocket for that. Anyway, that's maybe a bit of a side note, but it's an important one.
We're here for tangents. That's the fun part of these discussions. And if anybody, all of you listeners, really appreciate you, want to be as responsive as we can to your questions. I know this is a very new area and new subject, so please throw them in chat. We would love to answer those as well. But carrying on, you mentioned a tape.
Yes.
Could you explain a little bit more about what that is? Because so many people just don't know.
Yeah, sure. So, and it's less common again today. It still happens, but less common. So back when I started, you would get these tapes, and that's a spreadsheet that has loans that whoever the mortgage holder is looking to sell. And I mean, going back in time, 2010, 11, 12, even those first few years, oh my goodness, I would have a different Google spreadsheet for every month. And every month I would get sent anywhere between 10 and 15 different tapes from different sellers. On those tapes would be anywhere from, and again, going back, anywhere from like 100 to 300 loans per tape. So I would be looking at thousands of different loans for sale every month, back when that was much more common, and that was kind of the way it was done. All non-performing, all people that were struggling with their mortgage in one way or another. Just to kind of give you the scope, it was crazy.
And just as a summary, the tape is really the summary of a grouping of loans that gets sold as a package. And if you're doing your own fund, or if you are stepping into a note seller position, you can take those loans and sell them at current market prices when you got them as a discount, kind of that wholesaler buying the group discount. Right. Just kind of want to explain that a little bit more.
Yeah. And then on that tape, so just to give you an idea of the information, you'd have, the property address, you'd have, the first time they made a payment, the beginning date of the loan, the last time they made a payment, the next due date, the interest rate, the maturity date when that loan is going to be completed. Sometimes you would even get the social security number of the borrower. Most likely you'd have the name of the borrower at the very least. And every tape was a little bit different. So you'd have all kinds of different information on there. And it's those kind of numbers that we're looking at and kind of making a determination of, okay, what do I like? What do I not like? And how to make it worth it for me.
We're talking summary information.
Yes.
But there are loan documents, actual signatures that are behind it.
Right.
Otherwise, you're really not buying the debt. The debt is actually reflected as that piece of paper. Right. How do you know it's a good loan that's on the tape versus oops, go collect, but we don't have all this information?
A lot of it comes back to the relationships that you have with different people. There are reputable people that sell, and there are less reputable people that sell. And, you know, the chain of people that are reselling a tape that they've got from somebody, going back, we call that a daisy chain. There were those, but then there are the others where they literally just bought this, you know, portfolio of loans from US Bank, and now they're reselling this portion of them because they don't fit their box, something like that. So that's a big part of it just off the bat. Next, once you know that you can trust them or not trust them, you can request those backup documents, and you get digital copies of, you know, a copy of the note and mortgage, a copy of any assignments of how this loan has changed hands over the years. In some cases, we even got like the application form for the borrower, all kinds, again, it varied slightly, but at the very least you had the note, the mortgage, any assignments, and allonges that go along with that as well.
And just to be clear, an allonge is an assignment. I have no clue why they call it different in mortgages. But again, like a mortgage and a deed of trust, same thing.
Yeah. So, and depending on the state, the different courts are going to request different kinds of things, and some care about the allonge, some don't. Anyways, there's a lot.
You are thinking about buying a particular debt. What kind of due diligence do you do, and how?
Yeah, so a few things. I'm always, it's real estate backed, so I'm definitely interested in the real estate. What I'm looking to find out is what I want to know is, what is today's value? I want to make sure I understand how much the house is worth in today's condition, not an after repair value, not a future potential value. I want to know today, you know, if it's got broken shutters, what is that? How does that reflect in the price of the home? And as much as we can drill down to, you know, what is that house worth? In case of, again, going back to that same scenario where if I need to foreclose and take back this property, I want to make sure that it's well secured by whatever I paid for it.
Okay, so I got a horrible question for you.
Sure. Yeah.
Do you use Zillow to figure this out?
No. We use Zillow in, here's how I use Zillow. So the Zestimate, absolutely not. No, I don't know how they're getting those values, but in almost every market, there are a couple of markets where they're actually pretty close, but in almost every market, they are so incredibly far off. I don't know how they're doing that, but anyway, but I'll use Zillow.
Making stuff up.
Yeah, it looks like it, but I will go on Zillow and look at like a map view, and I'll, you know, go a 1 mile radius and look and see what has sold in that neighborhood recently, you know, in the last 6 months. So that's how I use Zillow. And same thing with Redfin. I'll do the same thing with Redfin. The Redfin value tends to be a little closer, but still, I'm not going to put too much faith in that. So I'll look on the map and see, okay, what sold in the area. That's your best guess. After I've done that, and once we've determined that, yes, this is a loan we want to go forward with, then I will actually have a local realtor go out, look at the house, give me their best estimate on what they think the house is worth, and just to kind of verify what I've come up with.
Called a BPO, or a broker's price opinion.
Right.
It's not a full-blown appraisal. It doesn't cost the same as a full-blown appraisal, but you got some boots on the ground actually looking at the property versus trusting what's on the internet someplace.
Yeah. And we've had it where, you know, we sent somebody to go out and look at the property, and it's no longer there. It's got knocked over by the city for, you know, different reasons, or blight or something. So yes, you absolutely want somebody local to set eyes on it and make sure that they can tell you what is really going on. Does it exist? First of all, it does. Are there broken windows? Like, you know, what kind of condition can I see in person versus on a computer screen?
Got it. All right. So we've looked at the property. We've got a digital copy of the documents. What else are you looking at or considering as just part of your due diligence?
Title is the other big one. So we'll do a title search, not a full-blown title report, but a title search just to show us any liens that are attached to the property. That'll show up there. Some liens are superior to my first lien, some are not. And so that's another thing you got to just learn. So IRS is superior. City liens are superior. Other kinds of liens are not.
Is HOA? I think that's a super lien.
In some states.
Okay.
Just to make it interesting. So roughly half the states an HOA is superior. The other half that it is not superior. So I want to kind of get the impression across, like, anybody can do this, but let's be clear, there is stuff you need to learn. Like, you can't just walk into this because you used to do real estate in the past. It's a different game, and you have to learn the rules and how it is played, because we're talking, basketball versus baseball. They both use a ball, but they're very different rules. So just make sure that you understand how that works.
Well, I think you nailed what's next. Like, how if I want to get into it, how do I learn or get educated on not getting screwed, basically?
I don't teach. I'm just
but
not
but
I know people that do.
Point me in a direction. Like, how do I learn how to, or do I just go out and lose a bunch of money and say, now I learned something?
You could try that. Sure. There are people that teach, and I'm not one of them. However, if you actually want to take some classes, for sure, there's some really good teachers out there, and I can refer you to some.
All right. So what I'd like to do is check out the summary once we get this actually reposted and summarized, and we'll include some of these educational platforms and resources, because it is, don't go out there and just start swinging for the fences, because you can lose your money, you can lose investors' money. Yeah. Know what you're doing first.
There are real risks, just like any investment. There are real risks, and so you need to learn how to mitigate those risks. So take care. Otherwise, the other thing, go to Diversified Mortgage Expo. It's a
whether you're new or old or looking to get into it or have been doing it for years, it's your opportunity to network, mix, mingle, and learn from the guys that are already doing it. So we'll include information in the summary as well.
Yeah, and really, it's the not so secret is it's all about relationships. And so the way you do that is you go to note conferences. There's one coming up here in Dallas, just at the beginning of November, Note Expo. I'll be at that one as well.
It's gotta have lunch.
Yeah, it's really important. You've got to get out there and meet people and just, shake hands and look people in the eye, not over a computer screen, and actually sit down and have face-to-face chats. It makes a huge difference. And I think I could say that's been kind of the secret to my success, is just getting out there and networking, even though I would way rather just sit at home and cuddle up on the couch with my wife. But it makes such a difference. You have to put yourself out there. And as an introvert, that's me speaking. You have to. You just do.
Is that where you're going to find note sellers, or are there different places you can look? But again, we want to stay with the trustworthy sellers, not Bob the drug dealer down the street that's, I got debt, I got notes, I got weed, what you need.
Yeah. That is going to be one of your best sources, is just going to talking to people in person. We'll plug PaperStack. PaperStack is a great platform. I've known these guys since they started, and it's a place where people can just go and post their notes. So to be clear, they're not necessarily going to be good notes. Just anybody who wants to post their note on there can post their note. So again, buyer beware. Like, you have to know what you're doing before you start just throwing out bids on stuff you want to buy. But that being said, it's a great place where a lot of people go and post their notes for sale, and they do quite a bit of business every year with people just buying and selling through their platform.
So I know quite a few people that we work with, also people that are watching. they own portfolios of rental properties or
Mhm.
Airbnb or short-term rentals, aka the same thing.
Yeah.
Um, you know, and I know some of these guys that are making millions off the interest payments and owning the notes and doing the seller finance strategies.
Mhm.
If you could talk to those guys that, hey, I own a portfolio of rentals
Mhm.
and I'm trying to figure out what's next, what would you tell me?
I would say I've been in your shoes. I've done the landlord thing. What if, what if you could have all the cash flow without any of the headaches? Does that sound like something that might be interesting to you? Um, I would say look at some of those rentals that have been your problem rentals. Your best ones, you know what? Hang on to them. They're great. And the thing you don't get with notes is you don't get the property appreciation because you don't own the property. So it's not necessarily an either or. I would say it's and both. But maybe look at your trouble ones. Same thing with the short-term rental people. Look at the ones that maybe are not your best producing, and then consider selling those on terms. Create yourself a note that's going to pay you reliably every month, where you don't have to fix the roof, you don't have to go and clean the room after somebody's left. Just consider it. Consider that that's an option. And then if you want to get really cool, then you can look at selling that note to me, and I will buy the note and cash you out. And you can go and use that cash and do something else with it.
I think, just to put them in terms that we're used to talking about with doing like funds and
Mhm.
investment terms.
Right.
I would think about this as like a preferred return only because you're fixed, you're prioritized, you know you're going to get paid,
Mhm.
versus that common equity, the for-profit owner, that they're actually the ones that are subject to, they're
Right.
subordinate to that preferred return, to that top level payments.
Yeah.
But if things go really well, I'm going to do better than you. If things don't go well, you're going to do better than me. So kind of, I would almost call it like an insurance contract. It's annuity. You're going to get the stream of payments that is well defined versus taking the risk that the real estate does well.
Right. Right. Yeah, exactly. Exactly. And then again, there's lots of different strategies. If you want to be hands-on, go and, buy some notes, go create some notes. You can keep them, sell them, whatever you want. You can even take a step back from that and you can invest into a fund. And you guys put together a fund for me here, not long ago, and did a great job, by the way. I would highly recommend. I tell everybody, if you're going to look at doing some kind of fund, any kind of syndication, go talk to these guys. They know what they're doing. But
Thanks
that's
for the
another way.
pitch.
Yeah,
We're
absolutely.
not here for that, but I appreciate it nonetheless because we are the best.
Absolutely. But that's another way you can do this is totally, completely passively, where you can put your money with somebody that has been doing this, that does know what they're doing. And then you just collect an annuity, and you're just collecting on money that you've invested that you don't have to do anything for. So that's another consideration.
So let me ask, you're managing a fund, complete pain administratively. Is it worth it? Or my God, this is just so much work and investors are annoying. Like, what's your own experience and opinion?
I really think it's totally worth it, because one of the big reasons that we switched from working with individual partners to go into a fund was the ability to consolidate funds. And before, when we were doing our JV thing, everybody, because we're not a fund, we can't commingle anything. So we've got separate books for, at the time, it was like 23 different investors. Like, that was a lot of administration, talking about administration. So every quarter we were having it, my poor wife, she was the one that was compiling everything to send to the accountant just for the reporting. So every quarter she was spending, an entire week putting all this information together. And it was really her that said, "Is there a different way we can do this?" I said, "Actually, yes, there is." We could go with a fund, and then in that case, then now we can commingle, and it all kind of goes into one pot. So that means one report going out to different investors, and just far, far simpler structure administratively. And then for the investor, they're part of a larger pool. So increased safety on that, far more predictable than, a non-performing deal where they may or may not get paid this month, and how much we're not sure yet until it closes. Like, there's far less ambiguity on what your return is going to be and when.
We would call that diversification.
Absolutely. Yeah. and that's exactly it. I don't know if you're heading out to, there's a alternative asset summit at the end of this month in October, out in Scottsdale.
Well, could you say that again? You just froze for a quick second.
Oh, sorry. Yeah. Put on by Directed IRA. It's called the Alternative Asset Summit. We're doing all kind of plugs here, but all about how you can apply your IRA funds into alternative investments. And my pitch and my plea to those people is, look at diversifying. If you want to put your money into a syndication that's going to pay you out 5 years from now, and it's going to make you, 80% return or something like that.
Gajillions.
Cool. Yeah. Put some money into that, but please don't put all your money into that. My father-in-law got into one of those, and guess what? It didn't work. And, he put in 100,000, and he got, of his capital, he only got 40,000 of that back. So like, that hurts. This is a guy who's looking at retirement, and that's a big chunk for him. So I've seen that, and I don't mean to scare people away, but I'm just saying, don't put all your money into something like that. Look at diversifying and put some money into those big ticket ones, put some money into something like a fund, mine or somebody else's, but put it into something that's going to be far more predictable, far less risky in that sense.
And to draw the distinction, and we kind of did, well, I'm going to do it again.
Sure.
If you're investing into a syndication, generally you're investing into that upside that has nothing to do really with what you're paying the bank. But
Right.
The bank's always paid, or they get the property.
Mm-hmm.
These
Exactly.
diversifying into notes is, you're not going to get that huge gain. If there is a gain, and if there is a loss,
right,
on the equity side, guess what? The first guy's getting paid is the bank, and you can be the bank. And that's what we're talking about right here.
Right. And this is your sleep at night money. It's like I say, far more predictable. Is it guaranteed? No, of course not. But it's your sleep at night money, where you can sit and relax and know that we're okay.
So, and I love you said, it's not guaranteed money. With all private investing, there are no guarantees.
Right.
There are risks. So it's just something that you need to know about. But for that, risk and reward, you should be expecting above market style returns or safety returns.
Right.
God, I just use the exact same word that I said don't use. Don't say safe. But you are prioritized, safer-ish.
Yes.
You are in a priority position above the guys that things go great, they'll make more. Things go not so great, you make more. Right. At the end of the day, that's what it comes down to.
Yeah.
I would like to speak to what I've witnessed this time and time again. And I've been working with hard money lenders, debt buyers, fund managers for a couple of decades now. And during the Great Recession, that was like a boom time of people doing funds, hard money loans at 15%, just ridiculous amounts.
Sure.
But what I've seen repeatedly are the guys that are creating the notes. Either they're making the loans, or they're doing the, seller financing style.
Yeah.
Initially, they're using their own money, but you know what? Your piggy bank runs out.
Right.
Next, you're JVing or
Yeah.
working with wholesale partners
Yeah.
to do notes. And that's where you end up with 20, 30, 50 notes that you're separately accounting for, separately managing.
Yeah.
And then all of a sudden the light bulb goes off and you're like, well, I don't really want to do that. Let's do a fund.
Right.
Big bucket of money, investors come together. And you know what? There's guys that are doing this with billions of dollars in this industry.
Absolutely.
But you got to start somewhere. And having that experience and going through the pains of realizing, hey, if I just had a bucket of money, this would be so much easier.
Yeah.
And people expand and grow from there. But then the last step, and I want to ask you if you've hit this last step.
Sure.
Really leveraging as kind of a derivative.
Yeah.
The funds in the fund.
Yeah.
So to explain what I've experienced in the past is the ability to either sell the notes at less than the interest rate that it was bought at. So you're keeping a spread continually, like a bank, increasing the amount of return you're getting for that same dollar.
Mm-hmm.
I've also seen where people sell parts of the notes, keep the other part, but make sure that their expense and their risk gets covered, but they still have this other asset that they're holding on to as well. And that is where it gets to be a little bit more sophisticated, but also where you start getting that bank return of $100, maybe 10x the interest rate returns by scaling, leveraging, and creating, I call it derivatives, but other contracts or interests that don't include a direct ownership of the loan.
Yeah.
Have you been dealing with any of that yet?
I haven't. No. And we'll see. I've been nervous to get into that just because I haven't done it before and I want to make sure I understand it well before I jump in. But for me, I'm at the point in my life and my career where I'm looking towards winding down, where our youngest is just turning 15 here next week. Just started grade 9. And so he'll be graduated here in the next, moved out of the house sometime in the next 4 or 5 years, maybe. We'll see. But
maybe, nowadays they stay till 25, 30.
Yeah. But I'm
expecting my kid to live with me until I'm 50.
Yeah, exactly. But we're looking down to, at that kind of life. What does that look like at that point where it's just my wife and I? And so we're looking at structuring it now so that by the time we are empty nested, then we have our own portfolio, separate from the fund, separate from anything else going on. That is just, it's enough to support us and we can go and do whatever the heck we want. We'll travel and see the kids. We'll travel and see the world. We'll stay at home and knit socks. I mean, who knows? But we can do whatever we want, whenever we want, because we've got our own fund set up we're self-funded.
And let me speak to that a little bit because it's a different way to retire and live well that people honestly just don't think about. Hey, I got a job. I contribute to my 401k. They're going into mutual funds, blah, blah, blah. All of that is a capital gains type retirement. You're hoping to save enough and grow enough that you can live off this for the rest of your life. But at least in my opinion, and this is how I live my life, there's a better way to do it. Yeah. And that's building your cash flow through multiple streams of income. I do it a lot with creating businesses, growing businesses. But you know what? The exact same thing applies with acquiring a portfolio of debt and notes that are constantly paying out passively. Yeah. And every one of them is a new stream of income. So there's like the secret sauce of everybody can retire off this, even if you're not sitting on millions and millions and millions of dollars.
Right.
But having that cash flow.
Yeah, exactly. And so that's what we're working towards. And it took some real kind of soul searching to go, okay, so how much do we want to grow this and for what purpose? And when we started thinking about, well, what's the purpose? We started really recognizing that we're not interested in just growing for the sake of growing. For us, there's that end goal. And for us, that end goal is once the kids are gone, we want to be totally, financially independent, where we've got that portfolio, money coming in every month without really having to do very much for it. A few hours a week, that's fine. I can deal with that. And then we can go, I can do that from a cruise, and manage the portfolio while we're sitting on the beach somewhere.
Let me go ahead and completely disagree with you.
Okay.
Because I love what I do. I never want to retire. But rather than just like relying on these streams of income, I want to love what I do every day. And that's the reason why I do these, is to share and share alike with everybody that's watching. You can do it too, whether you want to retire and live the good life on that cruise, or just continue to grow, because you know what, there is no number of retirement. There is a day that it's not fun anymore, and then I quit.
Right. And it gives you the ability to quit whenever you feel like it. And whether that's till you're 85 years old, great.
You know what? I spent 3 years on the golf course in quasi-retirement, and I got to tell you, it was boring.
Yeah. And I'm very much aware of the boring factor. And so that's, again, that it's going to be an individual thing. Make sure that you've thought that through. And what are you going to do with your time? That's a big deal.
I love it. Well, Nathan, my name brother from another country.
Yeah.
Thank you so much for joining today, teaching a little bit about debt buying, debt investing. And we talked about getting started, growing to that next level. And really important for everybody to know, we're talking about the biggest banks of America makes billions doing the exact same things that we're talking about. Yep. So be smart, take control of your own destiny, and start investing in debt.
Awesome. Thank you.
Thank you, everybody. Really appreciate you joining today. See you soon.